Most people use Claude AI like a chatbot. They ask a random question, get a quick answer, and move on. But if you set it up the right way, Claude can work more like a personal hedge fund analyst. Not as a magic stock picker and not as financial advice, but as a research system that helps you collect filings, read earnings reports, compare companies, spot risks, and build a clearer investment thesis. The real advantage is not asking Claude, "What stock should I buy?" The real advantage is giving Claude the right data, the right framework, and the right job. In this video, I'll show you how to use Claude like a disciplined analyst, how to screen companies, analyze SEC filings, track insider activity, score stocks, review risk, and turn messy market information into a structured research process you can actually understand and use. Number 1, the goal. What people usually get wrong about this topic is the word hedge fund. You are not trying to turn Claude into a machine that magically tells you which stock will go up tomorrow. What you actually want is something much more useful. You want Claude to act like a disciplined research analyst. That means it should gather the right documents, summarize what matters, compare a company against peers, flag contradictions, and help you make a cleaner decision. That is the real problem. Most retail investors do not lose because they have zero information. They lose because they have too much scattered information and no process for turning it into judgment. Claude helps when you use it as a process engine, not a crystal ball. That matters even more now because Claude can handle very large contexts and many PDF pages in a single request, which makes it realistic to work across filings, transcripts, and notes in one research flow, instead of breaking everything into tiny pieces. Number 2, stop asking for picks. The fastest way to get weak output is to open Claude and ask something lazy like "Give me the best stock to buy right now." That creates a fake shortcut, and fake shortcuts create fake confidence. A real analyst starts with a universe, a time horizon, and a reason for looking. So before you ask Claude anything, define 3 things clearly. First, what kind of investor are you right now? Long-term investor, swing trader, or watchlist builder? Second, what universe are you screening? Maybe S&P 500, maybe software stocks, maybe utilities, maybe companies with positive free cash flow. Third, what decision do you need made? Are you looking for a long idea, a short watch list, a risk review, or a peer comparison? Claude becomes much better when the job is narrow and explicit. Anthropic's own documentation pushes this same idea in a system form through repeated instructions, project memory, and tool connections. So do not ask for a pick. Ask for a job to be done. Number 3, build the data stack. If you want hedge fund style analysis, you need hedge fund style inputs. Start with the SEC filings that actually matter. 10K is the annual report. 10Q is the quarterly report. 8K is the current report for major events. Form 4 is the report for changes in insider ownership. 13F is the institutional holdings report. If you skip those and rely only on social media summaries and price charts, Claude will give you a polished version of shallow research. This is also where many viewers need one important warning. 13F is useful for seeing what large managers owned at quarter end, but the SEC says it is filed within 45 days after quarter end. So it is historical evidence, not live positioning. Treat it as a clue about crowding, style, and manager interest, not as a real-time copy trading signal. Build your stack around filings first, then add price data, valuation data, earnings call transcripts, and peer comparisons. Better inputs do not guarantee good results, but weak inputs almost guarantee weak results. Number 4, give Claude a real brief. Once the data is ready, the next step is not another random question. It is a structured analyst brief. Give Claude a role, a scope, a source list, and an output format. A strong version sounds like this. Analyze this company like a long-short equity analyst. Use only the attached annual report, quarterly report, recent current reports, insider filings, earnings transcript, and peer list. First, explain the business in plain language. Then identify what the market may be missing. Then list the 3 strongest bullish points and 3 strongest bearish points. Then compare valuation, growth, margins, and capital allocation versus peers. Then list what would disconfirm the thesis. Then end with what to monitor over the next 90 days. That kind of prompt works because it forces structure, evidence, and uncertainty into the same answer. If you are building a repeatable workflow, save those rules into a persistent project instruction file and reuse them. Anthropic also supports prompt caching for repeated prompt prefixes, which helps when you run the same research framework over many companies. Number 5, score before you judge. This is where you start thinking more like a fund and less like a fan. Do not let the first narrative win. Score the stock before you fall in love with the story. The competitor video is strong here because it uses a factor layer before portfolio decisions, and that is the right order. Your version does not need to be as complex as 8 factors and 27 subfactors on day 1, but it should still be systematic. A simple version can score each company on momentum, valuation, quality, growth, estimate trend, insider activity, and balance sheet risk. The exact weights can change, but the key idea is consistency. Claude is useful here because it can explain why each score is high or low in plain English, which makes the model easier to audit. If a stock scores well on growth and momentum but weak on balance sheet quality, you want that contradiction visible immediately. And if you use metrics like Piotrowski or Altman, treat them as supporting signals, not final truth. In the competitor transcript, Piotrowski is used as a financial health checklist and Altman as a distress warning, which is the right way to frame them. Number 6, read what most people skip. Most retail research spends too much time on headline numbers and not enough time on the text where management admits friction, legal risk, dependence, customer concentration, and ugly capital allocation choices. Claude is extremely good at helping here because long filings are exactly where humans get tired and inconsistent. Use it to pull out changes in tone, repeated risk language, accounting red flags, insider behavior patterns, and whether management explanations line up across documents. A useful prompt here is this. Compare the last 2 annual reports and the last 2 quarterly reports. Show me what risks got added, what risks got removed, what wording became stronger, and what management appears to be defending more aggressively than before. Then cross-check that against the latest insider transactions. This is also where a lot of people misread insider data. Insider buying can be a stronger positive signal than insider selling is a negative signal, because selling can happen for many personal reasons. So make Claude separate open market buying, option-related activity, planned sales, and one-off transactions, instead of dumping all insider activity into one bucket. Number 7, turn research into a decision. Good research still needs a decision framework. Otherwise, Claude becomes an expensive note-taker. After the analysis, force the output into one of 4 buckets: high conviction long watch list, high risk avoid, short thesis needs more proof, or no edge. That last bucket is important because most names should end there. You also want Claude to tell you what evidence would change the call. For example, if the thesis depends on margin recovery, ask what data over the next 2 quarters would confirm that recovery is real. If the thesis depends on insider conviction, ask whether the purchases are large relative to prior ownership and whether they came after weakness or after strength. If the thesis depends on valuation, ask whether the multiple is actually cheap versus sector peers or only looks cheap because earnings quality is deteriorating. This is how you stop treating research like entertainment. You turn it into a testable decision memo. In the competitor video, approved and rejected trade ideas are separated before execution, and that is a good institutional habit to keep even in a smaller personal workflow. Number 8, add risk before execution. Most people want research to end with a trade. Real processes put risk in between. Before any order is placed, check position size, liquidity, sector concentration, factor concentration, and correlation. If 5 of your favorite ideas are all basically the same bet on one theme, you are not diversified. You are just hiding one trade inside 5 tickers. The competitor transcript gets this right by separating research from risk management and by focusing on factor exposure, drawdown limits, and stock-specific risk. Your version should explain that in simpler language. Ask Claude to review your watch list and say where the same risk is showing up more than once. Ask whether your winners are driven by company-specific improvement or just by being in a hot sector. Ask what would hurt the whole basket at the same time. This is also the stage where you should set hard rules before emotions show up. For example, maximum position size, maximum sector weight, and what news or filing would invalidate the thesis. A good analyst finds ideas. A good portfolio manager prevents one idea from controlling the whole book. Number 9, test the workflow. If you want this to become a real personal system, do not jump from a good memo straight to real money. Test the workflow in paper trading first. Alpaca's documentation is useful here because it confirms that paper trading is a real-time simulation and uses the same API spec as live trading, which makes it good for testing order logic and automation. But Alpaca also says paper trading does not model market impact, information leakage, some slippage effects, regulatory fees, or dividend, so paper results are not the same as live results. That means your goal in paper is not to prove profitability. Your goal is to prove that the workflow works. Did Claude use the correct sources? Did the scorecard update properly? Did the thesis memo stay consistent? Did the order sizing logic behave? Did the alert fire when a new filing changed the story? If the plumbing is weak, live trading just makes the mistakes more expensive. Test the system until the mechanics are boring. Then you can decide whether the ideas deserve capital. Number 10, review and improve. The final step is where most viewers either become serious or stay casual forever. Every idea needs a post-mortem. Not just did it make money, but why? Did the stock work because your thesis was right? Because the whole sector went up? Because valuation re-rated? Because the market was short and got squeezed? Or because a risk you ignored never showed up in time? Build a small dashboard or journal that tracks thesis, entry reason, expected catalyst, disconfirming evidence, and what actually happened. Streamlit is useful here because its documentation shows it is built for data apps with charts, widgets, layouts, and cached computation, which is enough for a private research dashboard. And if you are using Claude Code, keep a stable project instruction file so the model does not change standards every session. Over time, this is what really turns Claude into a personal hedge fund analyst. Not one smart answer, but a loop. Gather evidence, score it, challenge it, decide carefully, track the result, and then improve the playbook. That is a process viewers can actually copy without pretending AI removed risk or uncertainty from markets.